Monday. This is Brew, co-chairman of Seifried and Brew, and as always, it's a pleasure to have my partner, Dr. Ed, talk to us about this quarter GDP release.
You're right, Jay. Last week we got the U.S. economy's report card, so to speak, for the first 3 months of 2011. Unfortunately, not great news. Here's what happened. GDP rose from the fourth quarter to the first quarter by 1.8%. That's down from the fourth quarter 2010's rate of 3.1. I should warn you that this is what we call the advance estimate. It's one of three GDP releases we get from the Bureau of Economic Analysis, the first one being the most subject to change. The second one will come out in late May, and the third one in June. And as you get closer to the final, you get more and more data. The missing data somehow shows up, and the numbers become more complete. So I urge you to take this with a grain of salt. It could be much higher than this, or somewhat higher, somewhat lower. Why did it go up and why did it go down? As you could guess, Jay, gasoline was a critical component of this first quarter GDP. There was a sharp upturn in imports. And we know oil is one of our big imports, and imports are subtracted from the GDP. Now, what helped the GDP was consumer spending increase again, inventories up sharply, exports because of the weaker dollar, fixed investment by businesses, and these were offset, however, by negative contributions from surprising sources. The federal government spending was down sharply, state and local government spending down sharply, and of course I mentioned the imports before. I want to start, Jay, by going to the second slide and showing our famous GDP equation, C plus I plus G plus X minus M, and this is going to be the basis for this morning's webcast. And if you're turned off by GDP, and I've said this over and over again to our banking friends, don't be. It's the source of core deposit growth. It's the source of loan repayment. It's literally the wellhead, Jay, that the river of banking forms from. So I urge you to pay attention to GDP because this will have a lot to say about the performance of your institution. And in fact, there's a lot to say about the risk involved in banking, which we'll talk about in a little bit. The third slide, Jay, shows some of the numbers. And I did something different this go-around. I thought they'd actually like to see the numbers in rather than an index number, actual dollars. And the government gives out two different sets of numbers. One we call current GDP, which is data that's not changed, adjusted for inflation, and one called real GDP, or adjusted to 2005 prices. So all the prices are taken back to a base year of 2005. And in this particular graph table, I showed not only the values and what they did, current dollars, which would be unadjusted, 2005 dollars, which would be adjusted, but also the percent of GDP of each of the components, Jay. And I think, as everyone knows, that the C component, consumption, is the largest by far and the most stable. It's the I component that's currently causing us trouble, even though it's the smallest of the components. But the viewer can take a minute to look at this. We now have a $15 trillion GDP in current dollar terms. Adjusted for back to 2005 dollars, it's $13.4 trillion GDP. And as you can see, and we'll stick with the current numbers, today's dollars, of the 15 trillion, 10 plus is consumption. About 2 trillion is investment, about 3 trillion from the government, all sources. Exports, we export about $2 trillion a year. We import about 2.5 trillion, and there's our trade deficit, 571.5. The next slide shows of the C, I, and G in net sector of our 1.8% growth in the fourth quarter, what percent of the 1.8 was attributed to what component. And you can see the consumer added 1.91% of the 1.8 growth, which would mean if all the others were zero, our GDP would have gone up by 1.9. Investment increased by 1.01, and as I said earlier, that's mostly inventories. The government spending knocked off a whole percentage point in growth from our GDP, and the imports 0.08%. The next slide shows, Jay, the fourth quarter to first quarter growth rates and annual rates for each component. And you can see consumer spending is slowing, Jay. Consumer spending was 4%, had 4% growth the fourth quarter, and the annual rate now it's down to 2.7, which is troubling. The real shock, however, is government. You can see government deaccelerated their spending even more. They dropped. They were falling at 1.7% last quarter. Now they're falling at 5.2%. Pretty staggering. When we look at the personal consumption growth in a little bit more detail, Jay, we can see that it did fall from 4% to 2.7% over the quarter. And some of the big deaccelerations were durable goods spending, which was 21.1% the fourth quarter, now down to 10.6% growth. And that fourth quarter was had to do with automobiles. Services up slightly, 1.4% growth. Now it's running at about 1.7%. The next slide shows exports and imports, export goods, export services, total imports, import goods, import services. And you can see, Jay, the sharp acceleration of imports. And that's oil and gasoline, when you value it on a price basis. Government expenditure, Jay, I think the real shocker here is when you break it down into federal defense, federal non-defense, and state and local, you can see that the defense spending has tailed off, which is surprising in the fourth quarter. It dropped 11.7% from the previous quarter at annual rate. And state and local off 3.3% at an annualized rate. So the government isn't helping much here at all. As you can see, it's actually hurting the GDP growth. And the big number, as we always know, is final sales. And as you can see by this chart, final sales, which is cash register sales, was increasing at a 6.7% rate the fourth quarter, but boy, it took a nosedive, didn't it, in the first quarter, growing less than 1% at 0.8%. The big change, of course, was the inventory adjustment factor. And then, Jay, finally, for the tail of the recovery, when the recession began, using an index number for GDP, we were at 105.737, with 100 being the GDP in 2005. And we got as low as 101.385 sometime in June, July 2009 when the recession ended. We've been recovering since then. At the end of the fourth quarter, December of 2010, our GDP was right about where it was before the whole mess began. So you can see from start of the recession to end of the recession to full recovery, about 3 years, Jay. The fourth quarter, a little bit of slow growth above that point to 106.334 index number. Two more slides, Jay, two or three more slides before we get into your part of this presentation regarding the impact of economics on banking. I thought it would be interesting to show the share of GDP over time.
Yeah, this is a great chart, Ed.
Yeah, this is an interesting slide going back to the 1960s, every decade or so, and then when we get to the more recent years, we do it every half decade. You can see the goods as a percent of GDP, Jay, started out in 1960, 33.6% of GDP. That's fallen to 24.2, most recent quarter. It's the services that are striking, aren't they? They say we have a service economy, and boy, you can really see it. 29.4% of the GDP back in the 60s, today up to 47. One more point, returning to the goods column, you can really see the impact of China, can't you? Goods were 33.6% of our GDP before, now they're 24.2. Much of those imported goods offshore, subtracting from our GDP. But it's the third column, housing, that has you and I just scratching our heads. Jay and I view this particular column as probably being the biggest headwind to recovery that we can see, not just in the economy, but in banking. Housing, which you can see back in the 60s, was about 5% of GDP. In the 70s, 4%. 80s, 4.9. 1990, a recession period, 3.5. 2000, 4.5. The bubble year of 2005, 6.1, the highest it got. Last year, a poor 2.3, and first quarter of 2011, even lower 2.2. Jay, talking to my banking friends around the country who tell me that they thought housing was not an important part of their portfolio, now come to realize it's much larger than they thought. There are these peripheral businesses, not builders per se, but peripheral businesses that they do business with that are being affected. Have you heard similar comments?
Absolutely.
Which I think is pretty interesting. I also wanted to show the group the latest from the Fed with respect to forecast. Once a quarter, the Federal Reserve Board of Governors and the 12 Federal Reserve Bank presidents get together and they give their forecast for GDP, unemployment, and inflation, both headline and core, for the next 3 years and beyond. And these forecast days are typically very, very well researched because they want to be right. And the Minneapolis Federal Reserve is competing against the Dallas Federal Reserve, is competing against the Atlanta Federal Reserve, and whoever has the best forecast, they get more prestige. But what's surprising with this slide, as our viewers can see, there's a central tendency forecast, the sort of the first grouping, Jay. And here they take out the 3 highest and the 3 lowest of the forecast. And you can see they're pretty well bunched together within 2 or 3 or 4 tenths of a percent of forecast. For example, real GDP is expected to go up somewhere between 3.1 and 3.3% in 2011, 3.5 to 4.2 in 2012, somewhere between 3.5 and 4.3 in 2013. But then when you look at the range, which includes...
Drive a truck through it.
Yeah, you can drive a truck through it. It's all the forecast. And gee, it's amazing that these people who work for the same agency, who sit with the same meetings, who have the same computers, can come up with such different forecasts. We're talking